Today's topic, the largest SPAC of the year, Pershing Square Tontine Holdings. So let's get started. Hey everyone, welcome back to my channel once again. This is Abhishek bringing you today the largest SPAC of the year. Yes, Pershing Square Tontine Holdings. And we're gonna have a detailed analysis on this particular investment. But with that being said, please do your own due diligence as well, because I am not a financial advisor, guys, and this video is just to help you guys out to have an idea about a particular investment and to help you with your own due diligence. So make this as a part of your own due diligence. And before we jump onto the main content, this is a small reminder and a request to please hit that like button. This small effort of bringing the cursor down to that like button and clicking it really helps the channel. And for those out there who haven't subscribed the channel yet, then consider subscribing, join our amazing community, and yeah, be a part of it. So now, without too much of blabbering, let's just hop right into the video. So guys, we are talking about Pershing Square Tontine Holdings, which is trading at New York Stock Exchange with the ticker symbol PSTH and is at $25.89 at the time of making this video, and as you can see is almost up by 2% with a market cap of $5.176 billion. And when we talk about this company, well, then one of the most important things to be considered by the investors is the brain behind this, who is none other than Bill Ackman. And why is this so important? Well, because this company is a special purpose acquisition company, which means it is designed to merge with another company which is looking forward to go public without an IPO, in simple words. But this is not like any other SPAC, because in this case, we actually don't know that with which company it is actually going to merge with. And this is what makes this SPAC quite unique. Now, there are many speculations out there that with which company it is going to merge, but we will get on to that later in this video. But despite of that, we are literally just betting on this one person and his abilities to read the market when we are looking into this stock. So Bill Ackman is a big name in hedge fund management world and is an activist investor like Carl Icahn, Daniel Loeb, and Nelson Peltz. So these are some really big names in the world of hedge fund management. So just to understand that what these people actually do as activist investors. So activist investors are shareholders at publicly traded companies who attempt to affect change in an organization either by directly appealing to or putting heavy pressure on the company's board of directors bypassing the normal advisory process. So in short, they are helping the management, or let's say shaking up the management of the particular company in which they are invested, to improve in case of any lags in the business progress. So Bill Ackman is the founder of the hedge fund management company Pershing Square Capital Management, and Bill Ackman's current net worth is $2 billion. So Bill Ackman founded this firm back in 2004 with just $54 million with his former business partner Liquida National, and in the first 10 years, the company actually managed to deliver $11.6 billion gains. Now, the company does have a team of 10 amazing advisors, but still, Bill Ackman is the majority owner. And since we are just betting on this one person's capability to read the market, then guys, here is one recent example of his skills. He recently bet against the market, or let's say practically did a shorting, which means that he bet that the market will fall. And of course, he was right on this. And the result was that he yielded $2.6 billion return, which is a 100-fold return. Which actually tells me that this guy with his skills to read the market quite efficiently is worth to at least look deeper into this investment. So then let's dig a bit deeper. So then let's first have a look at the Pershing Square Capital Management Company, which was of course founded by Bill Ackman, and look at its performance to know how this company was handled and has been performing over the last years, because then we can get a basic idea of how the Pershing Square Tontine Holdings might perform in the future considering the same management skills and the business ideas behind. So like I said, that it's a hedge fund management and holdings company. That means they buy into common stocks and hold them, or let's say they invest into companies like we as retail investors do, but just of course in big quantities, and then they sell them at a profit. But not just that, guys. Apart from that, they also play quite a significant role to also help planning their business strategies, because like we saw earlier that Bill Ackman is also an activist investor and that's their role. So they hold and have invested in some big and well-known companies like you can see right here, Chipotle Mexican Grill with a stake of 14.7%, followed by Hilton Worldwide 9%, and similarly Starbucks, Lewis, Restaurant Brands International, and Agilent Technologies. But the eye catcher is this one right here, Berkshire Hathaway, which is managed and owned by none other than Warren Buffett. And this is quite a plus factor for me as an investor. And why so? Well, we will get on to that in a moment. So the company claims that they did not have any detractors in 2019. That means every company in their portfolio generated positive returns. In other words, the company performed quite good in 2019, which is actually another positive point from an investor point of view. So now coming on to our previous statement that why their investment stake in Berkshire Hathaway actually matters for me as an investor. Well, here is the answer. So they believe that they have improved their recent performance, which is a direct result of their renewed focus on their core investment strategies and organizational changes, which they have implemented at Pershing Square. So opportunistically redeployed capital into two new positions that are well aligned with their core investment principles. And here lies our answer. So they have redeployed capital into two new positions that are well aligned with their core investment principles. That means their investment principles are same as of the company Berkshire Hathaway, which in turn means that they also believe in value investment like Warren Buffett. And if you are a regular viewer of my channel, then you know how much I praise Warren Buffett and his ways of analyzing the companies and studying the fundamentals of the company and his great belief in value investments or undervalued companies. And this actually then gives us one more reason to think about investing into this company. And since we just mentioned their 2019 performance, well, apart from performing alone, they also outperformed many of the indices in the same field, including S&P 500. So as you can see right here, the returns from Pershing Square Holdings was 58.1% in 2019 as compared to S&P 500, which was just 31.5%. And as we saw earlier, that one of their new investments, apart from Berkshire Hathaway, of course, was Agilent. And just to show you that this is not a small company as well, this has a market cap of $26 billion. And this is one more additional point to be considered, that they invest in well-established businesses which has a significant market value and is prone to future growth. So they are not investing in just any company or small companies or any startup businesses which might face losses because of expansions. Now, apart from that, Ackman's record of buying, building and merging companies has been quite impressive. For example, in 2011, the hedge fund co-sponsored Justice Holdings, a SPAC which went on to raise $1.5 billion. Pershing provided 30% of the capital. In 2012, the new vehicle acquired a 29% stake in Burger King Worldwide Holdings, inclusive for $1.4 billion in cash, and subsequently merged with Tim Hortons to form Restaurant Brands International, which we just saw a few moments ago, is one of the investments in Pershing Square Holdings portfolio. And if investors who would have bought into these companies during the IPOs would have seen a compound annual return of 19%, which is quite impressive to be honest. Also, Pershing Square Holdings has a track record of investing into companies at the right moment to take the advantage of the growth of these companies. And I would say to achieve this, such hedge fund management companies must have a great team of analysts to take the stake into such growth companies at the right time to take full benefit. And as we can see that they do have such a team and such potential. Well, and this is a recent example to prove that. So Pershing Square Holdings has delivered a 57% return through November 17, outspacing the broader market. And after the fund was down 7% in late February, back in March, Ackman famously parlayed a 27 million bet into $2.6 billion, which, by the way, is a trade now considered as one of the greatest of all time. Okay, so now coming on to the topic of Pershing Square Tontine Holdings as a SPAC, or a special purpose acquisition company, or a blank check company. So this SPAC is quite different and unique than all the other SPACs what we have seen this year, or in fact even from the history. So what are the factors which makes this SPAC the most unique SPAC of the year? Well, here they are. So the first point is the merging company is unknown. So since it is a special purpose acquisition company, that means it is designed to merge with another company which wants to go public. So when the company doesn't want to go through the initial public offering, well, then they follow this way. The second point is that the SPAC has already raised
$4 billion, which makes it the largest SPAC of the year. Well, Pershing Square has managed to raise $4 billion by offering 200 million units at $20 per share, but now they are planning or expected to raise an additional amount of $1.5 billion, making a total capitalization of $5.5 billion. So this is of course the largest SPAC what we will see. And the third point is the overall structure of the SPAC. So the structure of this SPAC makes it the most unique SPAC. And what I mean by this? Well, let me explain. So the investment in case of Pershing Square Tontine Holdings could be done through these three things. The first one is the units with the ticker symbol PSTH.U. U stands for the units. The second one is the common stock, which we saw in the beginning of this video trading at $25. And the last PSTHWS, and WS stands for warrants. So now what actually sets aside this particular SPAC from other SPACs? So a unit would be worth $20, and now the unit would be consisting of course, one share of Class A common stock and 1/9 of one detachable redeemable warrant. And what does this mean? This means that unless you as an investor purchase at least 9 units, you won't be able to receive or trade a whole detachable redeemable warrant. So for those who are new to this term stock warrants, well, here is a quick and an easy example to explain what warrants actually are. So for example, let's say ABC Corporation, which is the name of the stock, gives the stock warrant holder a contract to purchase 100 shares of the company at $20 per share, which is called the strike price, over the next 10 years. If at any point in this time during this 10-year period, the recipient buys the stock at the strike price, even if it's trading above that price, that's a good deal for the stock warrant. What it actually means is that for example, the stock price is trading at $30 per share, but you paid now $20 per share. That means you actually redeemed your warrant. So you say that, okay, I sell my warrant and instead I buy a stock. I buy this stock for $30 per share. That means at that particular moment, you already earned a 33% profit on your transaction, and you can simply exit the market or just keep the stock for long term, whatever. But on the other hand, if the price of this stock falls to $10 per share, then you're out of money because you're below the strike price, which was $20 per share. And that also means that, for example, for this 10 years, what we just saw before, that the contract is for 10 years. That means your warrant is available, or the validity of your warrant is 10 years. And if within this 10 years, the strike price is never reached, that means the price of the stock never reached to $20 and it always stayed below $20, then you have lost all your money. That means your stock warrant has expired and you were never able to redeem your warrant and you're out of money. That means it's practically zero. So that's actually also a big disadvantage for investing in warrants. So you have the upside, you have the downside, but anyways, this was just to explain what warrants actually are. So guys, here are the acquisition criteria which I took directly from the SEC filings. I will also put the link in the description section down below. So anyways, these are the different criteria and the guidelines stated by Pershing Square Tontine Holdings. That means they will only acquire or will decide to merge with the other business or company only when they fulfill these criteria. And this is what makes this special purpose acquisition even more special. Okay, so the first criteria is simple, predictable, and free cash flow generative. So they will seek for the companies with a proven track record of growth and profitability. That means they will not be acquiring just any business. So they won't invest in just a startup business, which are in the initial phase of product development and growth, because such businesses are more prone to losses, as these businesses have to put the money back into their business for growth and expansion. So they will be acquiring businesses which are already strongly settled in the market and has a good brand which is already developed. So moving on to the second criteria, which is formidable barriers to entry. So they will seek companies that have long-term sustainable competitive advantages, significant barriers to entry, or wide moats around their business. So in other words, they will be looking for the companies which have a unique product and whose product cannot be copied despite of the competition out there. So that means this makes it a low risk investment. So the third criteria is limited exposure to extrinsic factors that we cannot control or that humans cannot control. So considering the current global pandemic, that has affected a huge amount of different businesses, but still many businesses out there have not just been able to weather this storm, but also have shown profitability in the previous quarters. So they will be looking for such businesses which can sustain in such economies. So the next criteria is a strong balance sheet. So which is really remarkable according to me, because like we discussed earlier, that they are following the same principles of valuating a business or a company as Warren Buffett's. And this is one of the strong fundamentals which are really important for evaluating a business. And I like this factor. So moving on to the next criteria, minimal capital market dependency. So we will see companies that can benefit from being a public company with a broader access to the capital markets and greater governance, but will seek to avoid companies that rely just on capital markets to operate and grow their businesses, which is good. And then the next criteria is large capitalization. So they will seek for the companies which have a large enterprise value or has a big market cap. So they won't be looking for the companies which are small scale based industries or which have a market capitalization of just 200 or 300 million dollars, so that actually the target is that they can enter the S&P 500 index. And this is one of the reasons why they will be looking for companies with big enterprise values and significant long-term growth potential. Okay, so moving on, the other criteria is attractive valuation, and this is another great factor according to me. That means they will be looking for the businesses or the companies which are undervalued or which have an attractive valuation relative to their long-term intrinsic value, or let's say the companies which are doing really good or were doing really good before the pandemic struck. And last but not the least, an exceptional management and governance. So this is really important to have a great talented, well experienced, highly competent management team behind the business, so that the business are actually doing good and is not stopped by any upcoming hurdles, and the company can thus use the expertise of the team to experience growth and productivity. And apart from that, guys, Bill Ackman's hedge fund is not going to take any excessive fees. In fact, they will only charge a 6.21% fee when the investors get a 20% return. This means Bill Ackman is pretty sure that the investors will surely get a return of 20% on their investments. And this is the confidence we would like to see as investors. Okay, so now coming on to the last topic of this video, that is the speculations involved about which company Bill Ackman's SPAC might merge with. Now, there were few speculations or rumors out there about the companies that the SPAC might merge with, like SpaceX, Palantir, Airbnb, Stripe, and even Bloomberg. But recently, a spokesperson from Bloomberg denied this rumor. So this leaves us with the following four contenders according to the rumors: Airbnb, Bloomberg, Palantir, and Stripe. So Airbnb is already out because it is coming through its own IPO this week. Bloomberg, like I said, the spokesperson denied this rumor. Now, I am not sure, guys, that how honest this information is, but this is just from another article which I read, that the spokesperson denied the fact that they are looking to go public through a SPAC merger with, especially with Pershing Square Tontine Holdings. But anyways, nobody knows how honest this information is. But anyways, moving on. So Palantir, we already know that is already trading at the stock exchange. And last but not the least is Stripe, which makes the most sense to be the top contender for this merger. So just for those who are not aware about Stripe, so Stripe is an American financial services and software as a service company headquartered in San Francisco, and the company offers payment processing software and application programming interfaces for e-commerce websites. So it's similar to PayPal. And why I think that it could be Stripe? Well, because it matches many of the criteria which we saw from the acquisition criteria list of the SPAC, like its heavy valuation of approximately $36 billion and its strong balance sheet, of course. Plus, the company is considered heavily undervalued considering the growing internet economy. So according to all this information and according to the performance of Stripe, plus it's a really big company and it is well established and has a big enough market cap, plus the profitability of the company is quite good. So according to all these factors, they are pointing towards a good stable company which actually Pershing Square Tontine Holdings is looking for. And this brings us to my final verdict. So my final verdict is, despite of the fact with whatever company it will merge with, I'm sure the company would be very well established, like because of the acquisition criterias in all the fields. So I would definitely buy into this SPAC at $25 because the risk to reward ratio is quite good. Theoretically, it can fall up to $20 because of the warrant strike price being at $20, and this gives us a downfall percentage of just 20%. And compared to the upside potential, this is nothing, guys. So here I have a good risk to reward ratio, and whereas once it merges with any of the big well established unicorns, then the sky is the limit for an upside potential, like I said. And just for example, let's take case of Airbnb, which is opening up with a market cap of $36 billion at a price range of $40 to $50. I mean, if you can apply the same principles to this particular pack with the same business ideas like Airbnb, or let's say if it merges with Bloomberg or Stripe, then I think there is a really good potential in this stock. So I think, guys, that this is a really good investment according to me. Again, this is just my opinion, and I would be investing in this SPAC because this could be a really good SPAC for the future. Anyways, I would be holding this for long term, and I don't care when the SPAC merges. Of course, if it takes too long, and this is the risk factor involved, but anyways, I am going to take this risk, and it will still rise, I'm sure, above $25 for sure, because the investors will come in, and this has a good upside potential. So I'm not worried. I will put a stop loss, and yeah, that's my idea. And that's it for the video.
So if you guys made till the end, and if you're watching me right now, I just want to let you guys know that we have an amazing family of our new patrons, and it's slowly increasing. And if you guys are also interested to join this amazing family of our brothers and sisters, then you're most welcome. I'll put the link in the description down below. Here on this platform, we discuss everything about stock market, real estate, and we discuss about daily stocks as well, which I cannot literally put on YouTube. So that's it, guys. That's all for today. I hope that you really enjoyed this video, and I'll see you in the next one. Till then, stay safe, stay healthy, stay happy, and ciao.